All right, when we're in the category of awful charts, let's just stay there for a sec. Another one this morning that's moving around is Enphase after a pretty damning note out from an analyst at BMO following a year-long decline and a general sector-wide unwind from the solar support that the government gave this sector last year. A lot of these stocks have been huge disappointments. And I guess this analyst saying that maybe there could be some more to come, that there's a pretty major slowdown happening.
That's what it seems like. It seems like the estimation of how long this trough would last is really kind of being reevaluated. And that's what we have out of BMO Capital. They moved to the market perform from outperform price target at 148 down from 175, saying the trough in U.S. residential solar demand appears deeper than anticipated and the timing of recovery is uncertain. They said the firm that they now see fiscal 2024 revenues up only a modest 2%. They said it makes it harder for them to justify the magnitude of their previous valuation. Obviously, you pointed out, we saw a lot of these solar stocks, these clean energy stocks really rise after that Inflation Reduction Act was signed into legislation and really boosted these companies. And this solar power industry is certainly looked at as one of the kind of the fastest growing, and long term there's a lot of optimism around it. But we've been dealing with high interest rates. We've been dealing with them cutting prices as competition continues to grow, and that's really put a lot of pressure on especially these residential solar companies.
Okay. Yeah, all getting beat up this morning in unison. So it does seem like the tone is applying to all of them. Look at the TAN ETF. Yeesh. That is bad stuff. Down 28% last 52 weeks. Crazy. Even more if you normalize the chart back to the support from last year and the build for clean energy. They're down like 40%. So talk about a major letdown. Jeez. All right. In this category of clean energy, Tesla price target cut from Piper Sandler. Shares don't seem to mind it so much, Jeff, ahead of earnings.
Yeah, I think it's an adjustment that may have been expected ahead of earnings. And it's a lot of what we've seen from analysts over the past few weeks, especially since they announced their deliveries. They lowered the price target to 290 from 300, kept an overweight rating on the shares. They said, the model really reflects that recent disclosure of the Q3 delivery results, as well as some updated expectations for earnings. They said the Cybertruck and Tesla other growth initiatives are on the horizon, and there's a reasonable likelihood that its margins will bottom in Q3. Still, they expect that it's possible Tesla could trade sideways at best in the coming months. Looking into 2024, they think delivery growth will likely slow before reaccelerating, but they believe this is already reflected in the street estimates. And as you pointed out, we've got earnings coming up on the 18th. Wall Street expects about 73 cents a share. That's down from 77 a few weeks ago. Sales about 24.3 billion. Compare that to $1.05 and 21.5 billion last year. All of this focus is really going to be on the margins because we saw those delivery numbers and we've seen Tesla cut their prices quite a few times over the last year.
Okay. Interesting call that the analyst thinks it could go sideways. I don't know. Tesla likes to go up and down. Sideways? Not really. Not so much. Though it has kind of been here over the last month or so, I guess you could argue, but still a lot of swinginess within there and an obvious big uptrend off the lows, but still a downtrend off the $414 record in 2021. Very, very fun chart when you zoom out. We'll take a closer look at that throughout this week as we get into earnings.